Well, hello, and we will be getting started here in just a few moments. Want to give everyone a chance to get on and get situated. So just hang tight for a few seconds and we'll get started. Okay, well, let's go ahead and get started. First and foremost, I want to thank you for joining us for our June webinar. And for those of you that don't know me, my name is Nelson Negron, and I am the president of Provident Oak Financial. Wanted to just again say thank you for being here. So you're probably wondering why, with everything going on, we're doing a webinar about investing. And the reason is, and I'm sure some of you have asked the question, how do we invest during this time? So we wanted this to serve as a reminder of some truths that have proven themselves throughout history. And there's always something going on. There's never a shortage of cautionary tales whenever you turn on the news media, whether it's COVID-19, which we are trying to kind of navigate through now and find our new normal, whatever that may look like. And so we wanted to be able to maybe provide some information that would maybe give you some confidence and some comfort during this time when you look at your investment portfolios and maybe your financial plan overall. You know, the past few years has really given us some things to really think about when we look at things to be aware of or cautious of or concerned about. There's Russia, there's China, there was Greece, there was Italy, Brexit. So one thing that is certain is there's always going to be something that the news media is going to say we should be worried about, or this is the thing that's going to bring it all down. But I think if we look back at our history, when we look at the history of the market, we can see that there are some things that we can feel pretty good about. And so joining us today is Eventide's managing partner, Jason Myhre. I'm really excited about the information that he's going to be presenting to us. I think you'll find it to be very helpful, very informative, and really be, again, that reminder that and these things that we should be keeping in mind when we talk about investing. So at this point, almost forgot to mention, you do have a Q&A button down at the bottom of your screen. You do have controls there. So if you have any questions, please feel free to type those in. At the end, we will have a Q&A session to be able to go through those questions and see if we can get some answers for you. But with that being said, Jason, take it away.
Great. Well, thank you so much. And warm hello to all of you who are joining in on your lunch hour. Before we officially kick it off, we'll just give you a bit more of an introduction here. It's always good to know who you're listening to. My name is Jason. I'm a managing partner of a company called Eventide. We are a mutual fund company that's based in Boston, and our specialty is values-based investing. I'll talk a little bit about what that term means toward the end of the presentation. My day-to-day work is in an area that we call advocacy, which doesn't that sound vague? What I'm doing is basically I'm speaking to audiences and I'm advocating that we consider our values whenever we make investment decisions. Again, I'll touch on what that is. And with that, we will go ahead and dive in. So Nelson did a really good job of just setting the stage here, and we really don't need this setup, but I'll go through the process. We all know what's going on in the world today. We're still dealing with this coronavirus situation. The US is still the center of attention. When it first got started, of course, there was that exponential rise in the number of new cases, a lot of unknowns, really scary time. Now, thankfully, that has begun to abate and decline, and we've seen the number of new cases continually decline, and so that's very encouraging. I know lots of states are reopening and in various ways, and so we're all looking forward to being past this. But while this has been making its rounds in the US, we've observed the way that it has impacted the economy. So some entire industries have slowed down, others have come to a complete halt, and this has upset the stock market. When the market first began to sell off, it actually fell at its fastest rate in history. Not the deepest it's ever fallen, but the fastest rate of decline when it was falling. It eventually reached a bottom and began a recovery process that was actually pretty speedy. So the first week off the bottom, we experienced the fastest gain we've had since the 1930s. So a very volatile time. I don't know if you follow the investing news, but maybe you saw that, for example, the Wall Street Stock Exchange, or the New York Stock Exchange, actually had their trading breakers blown due to the volume of trades that were being put through. So somebody has to go and manually flip a breaker to get trading to resume. This happened on a number of days, pretty crazy. And during times of volatility, especially when the markets are going down, we begin to wonder, hey, was that financial plan that I had a few months back, is that still like a good plan? Is it still relevant? How should I think about investing in this crazy world, in this crazy time that we're living in right now? Well, I'm gonna depart from talking about the virus and its impacts on the economy and markets, and instead what we're gonna do, we're gonna take a step back, and we are going to look at just the timeless truths for investing. I'll show you this history. We have nearly 150 years of investing history in the US. And so we've learned some things along the way. And what I want to do is kind of collect the best wisdom from this long history to provide a sense of comfort, hopefully, during this time. I've got 5 points. I'm going to put them up on the screen. We'll walk through each one in turn. Number 1, keep your eye on the owner, not the dog. Number 2, restrain yourself. Number 3, employ a system that forces you to buy low. Number 4, remember the most powerful force in the universe. And number 5, invest in businesses, not stocks. We'll kick it off with the first one. Keep your eye on the owner, not the dog. What in the world? What do I mean by this? Well, it comes from my favorite quote on investing, which was said by this person, Ralph Myhre, who was a successful portfolio manager over a fund called the Acorn Fund. He has this very memorable illustration for how the markets work. And this is as recalled by a person named Bill Bernstein in one of his books on investing. Quote goes, he likens the market to an excitable dog on a very long leash in New York City, darting randomly in every direction. The dog's owner is walking from Columbus Circle through Central Park to the Metropolitan Museum. At any one moment, there's no predicting which way the pooch will lurch. But in the long run, you know, he's heading northeast at an average speed of 3 miles per hour. What is astonishing is that almost all the market players, big and small, seem to have their eye on the dog and not the owner. Hopefully the metaphor makes a little bit of sense to you. I'm going to make it real plain on this chart. What we're looking at is the entire history of investing in the US. Many of you will know the S&P 500. That's probably the most well-known benchmark for grading the performance of the stock market. All the S&P 500 is it's the performance of the 500 largest companies that are based in the US. The S&P 500 got its start in 1926, which was right about here on the chart. But the US stock market began all the way back here in 1871. And we actually have historical books and records of all the daily stock prices going back to 1871. And so what we're able to do is take the methodology of the S&P 500, apply it to that prior history. And the reason we're doing this is just to get one frame of reference for looking at the whole history the same way. Then we're doing a couple of things with the data to make sure we're looking at it properly. Number 1, we're adjusting it for changes in inflation. The reason we're doing this is to get what's called the real return, the after inflation return. The other thing we're doing is we're reinvesting the dividends from companies that produce dividends, because dividends are an important part of what's known as total return. All right, with all that said, take a look. I find this chart to be so comforting. And if you can sort of remember this, this is so key to investing with confidence, okay? So I'll walk you through it. The blue line, that's obviously the stock market. In the metaphor, that's the excitable dog on the long leash in New York City, darting randomly in every direction. There's no predicting which way the pooch will lurch. Similarly, it's impossible to predict the ups and downs in the market. The yellow line, all that is, it's the best fit line for the data. It's a straight line, there's no curvature to it at all. You can see what a good fit it is to the data. And you can see that basically the market, when viewed from a step back position, has basically been up and to the right on a steady rate for 149 years. In the metaphor, that's the owner who's walking the dog with purpose north and east at a steady pace. In investing terms, that steady pace is a constant 6.6% growth. And so what our job really is as investors, as best we can do it, is to try to not pay attention to the blue line, that is the dog, but rather to focus on this long-term trajectory. This is why people invest. It's because the market has had such a consistent experience in generating a constant rate of return. And so as best we can, we need to keep our eye on the yellow line, the owner, not the blue line, the dog. Hopefully you get this. All right. Number 2, restrain yourself. Sounds like it's going to get a little personal here. Well, a little bit. There is a personal side to investing, something we all need to reckon within ourselves if we are going to invest with success. And it's a really critical lesson. For this, let's go back and look at a Wall Street Journal article. You can see we're going back a little ways here, December 31, 2009. So every decade, there is crowned a new king of mutual funds based on whichever mutual fund has the best performance for that given decade. You can see here that what we're looking at is the kind of coronation ceremony for the king of mutual funds in the decade of the 2000s. It says best stock fund of the decade. Fund is called CGM Focus. The article reads, meet the decade's best performing US diversified stock mutual fund, Ken Huebner's $3.7 billion CGM Focus Fund, which rose more than 18% annually. That means 18% per year for 10 years, very impressive, and outpaced its closest rival by more than 3 percentage points. Now, I want to ask you a question. To get your response, I'm going to hit you with a poll, which will appear on your screen. And the question is this. This king of mutual funds in the 2000s got a return of 18% per year. How do you think the average investor in that fund did? Did they get the full 18% return, or do you think they got something less? And I've given you a range of choices here. What do you say? All right, you guys are taking to this. Appreciate it. Don't be shy. Leave it open here for another moment. The best fund of the 2000s got 18% per year return. How did the average investor do? Did they get the full 18 or something less? What do you think? Okay, I'm going to call it done here, share the results. So 33% of the audience thought they got 12%. So nobody thought they got the full 18. The majority answer believed they got 2%. Pretty bad. All right, well, we'll look at the right answer here. It is worse even than you thought. Check it out. Too bad investors weren't around to enjoy much of those gains. The typical CGM Focus shareholder lost 11% annually. That means they lost 11% per year for 10 years, according to investment research from Morningstar Inc. The best fund you could have picked in the 2000s out of mutual funds was getting 18% per year. The investors in that very fund are somehow managing to get a negative return. What in the world, right? What's going on here? Well, they explain these investor returns, also known as dollar-weighted returns, incorporate the effect of cash flowing in and out of the fund as shareholders, and here's the key, buy and sell. Investor returns can be lower than mutual fund total returns because shareholders often buy a fund after it's had a strong run and sell it as it hits the bottom. So here's what's going on. People are shopping for an investment. They want one with a good return. They find this one. They say, wow, look at the return on this thing. So they buy it after it's had a streak of performance. So they're buying it at a top. The fund will then experience a downturn, as all investments do, and then they'll give up. They'll say, oh, I bought a dog, get me out of here, and they'll cash out at the bottom. So they bought high, sold low, experienced a negative rate of return. The fund will recover, put on a streak of performance, attract a new group of investors who will buy it at the top, sell it at the bottom. This happens continually over a decade. You take the average, and the average investor has done all of the wrong things. Bought high, sold low, got a negative return, despite investing in the very best mutual fund they could have picked. This quote here, said by Warren Buffett, I'm sure you've heard his name before, is, I'd put it in one of the top 3 most well-known quotes on investing. He says, be fearful when others are greedy, and greedy when others are fearful. Meaning, if you look around your life and everyone seems greedy about investing, your friends and your family are telling you to pile into stocks, watch out. Historically, that's marked the market top, and so you should be more fearful or cautious about investing at that time. If you look around your life and everyone's fearful and panicking and cashing out of the market, putting money under the mattress, sky's falling, the world's coming to an end, historically, that has marked market bottoms. And so you should be more greedy and aggressive about investing at those times. That's the principle. I've heard this quote a lot, but there is a world of difference between saying this quote and being the disciplined person who puts this advice into practice. And it's very easy for us to point the finger at the CGM focused shareholders and fail to recognize that we can make the same mistakes. This is a book on psychology written by a person named Daniel Kahneman, who's an economist. You can see he won the Nobel Prize in economics. It's called Thinking, Fast and Slow. I don't know if you've ever heard of it. I'll save you the trouble of reading it if you can just get the premise, which is in this quote here. The premise of this book is that it is easier to recognize other people's mistakes than your own. So true in life, right? It's so easy to point out the flaws in others, not see that we have those same flaws or tendencies to make those same mistakes within ourselves. So what I want to do now is I want to broaden our search, not just look at one set of investors in one fund. Let's look at all investors in all mutual funds, okay? And what we find is that this is a very, very pervasive problem. We are all our own worst enemy. Check this out. We're looking at a 20-year history, 96 through 2015, the returns of various investments. What finished at the head of the pack was something called REITs. That's investments in real estate, office parks, things like that. Got 10.9% per year for 20 years. Next best, the S&P 500 at 8.2% per year. This is a blend of stocks and bonds, a different mix of stocks and bonds. Bonds themselves, gold, this is international stocks, sale of homes, performance of oil, the rate of inflation, and check it out, dead last are the average investor. And this is looking at all investors in all mutual funds. So this is a pervasive problem. Now, why? Why does the average investor underperform every possible investment, especially given the fact that they're owning these very investments? Well, for the exact same reason we talked about for the CGM focus shareholders. We like to dance in and out of the market, chase a hot return. We give up in the hard times, right? We make all the mistakes in investing. The lesson here is that there's a problem with investing, and it's often not with the investment. It's with us, the investors. We have to restrain ourselves from this behavior. I love this quote from Morgan Housel, who says that finance would be better if it was taught by the psychology and history departments at universities. Couldn't agree more. Showed you the history with the dog and the owner. The psychology is this tendency to love buying things when they're expensive and love selling things when they are down. Here's one more quote on this point from a legend from way back. When it comes to investing, the big money is not in the buying or the selling, but in the sitting. We got to sit tight, restrain ourselves. All right, number 3, employ a system that forces you to buy low. Investing, you've heard it, right? You want to buy low, sell high. So I want to talk about a systematic way that we can purchase our investments at low prices. For this, we're going to talk about an experiment together. This is going to be another opportunity for a poll, so pay attention. I want you to imagine with me that we were dropped into history somewhere between the year 1920 and 1979. So we could land in 1935, 42, 67, etc. And our job, our task, is that we have to invest in the US stock market for the next 40 years, okay? I'm going to give you a choice between 2 investment strategies. Option 1, you can invest $100 a month. Option 2, you can save up that $100 a month, keeping cash on the sidelines, and to try to buy the dips in the market. In other words, whenever the market crashes, that's when you invest. I'm going to sweeten the deal on option 2, though. I'm going to grant you perfect knowledge of the future. So you don't have to wonder when the market's going to crash. You're going to know. And you'll be guaranteed to buy the market at its absolute bottoms. Question is, which would you choose? That's going to be the poll coming at you. All right, here we go. Option 1, again, is just investing $100 a month over that 40 years. Option 2, saving up your money, saving up that $100 a month, waiting for the market to crash, buying those dips, and you're going to know when they happen. What do you take? All right. Great, thank you. Call it done here. I'll share the results. This is actually the most common result. I've given this presentation a lot. This is the most common result I get. 100% of people say they take option 1. Okay, so that's $100 a month. Now, let me say, this problem, I think the reason people choose option 1 is that it just seems so unlikely, right? It's just so preposterous. How in the world could plugging away with $100 a month be superior than buying the market when it is at rock bottom prices and, you know, just loading up whenever the market hits these bottoms? It seems like, hopefully you would agree with me, it seems like, at least on the face, that option 2 would be a slam dunk. And so you're suspecting that it actually is in fact option 1. Well, someone did this hard work. They did the experiment. They tried every 40-year scenario. They tried both strategies to prove out, in fact, which one was the better choice. I'll show that to you. So here's how to read it. When this blue line is above the horizontal dotted line, what that means is that that was a period in history where buy the dips was that was option 2, would have been the better choice to make. So you can see, for example, that if we landed in the 20s, buy the dips would have been a better choice. And again, in the late 30s, early 40s, buy the dips would have been the better choice to make. Whenever the blue line is below the horizontal dotted line, that's when option 1, investing $100 a month, is the better choice. And you can see it visually. You guys got it right. In fact, if you add it up, the amount of time that the blue line spends below the horizontal dotted line, it's 70% of the time, which is pretty amazing, 70%. Now, keep in mind, I granted perfect knowledge of the future to option 2, which of course none of us have, right? For example, I don't have a poll on this, but have we seen the bottom of the market in the coronavirus market sell-off? I have no idea. No one does. We don't know the future. And so in practice, when we don't have knowledge of the future, option 2 is actually really hard to do, right? We don't know when the market's going to crash, and so timing it is very difficult. And if we get it wrong by just 2 months and we re-crunch the numbers, we see that investing monthly outperforms 97% of the time, virtually the entire time. Now, how can this be? What is this magic, right, of investing monthly? Well, it's called dollar cost averaging. It's very simple. It's investing a fixed amount of money at regular intervals over time. Example of this is $100 a month, although it could be $500 a month or $500 every 6 months or what have you. And I'll show you on charts why this works, but here's the explanation. When we invest a fixed amount of money at regular intervals over time, the strategy will naturally buy more shares of an investment at low prices, which is what we're trying to do. And it will naturally purchase less shares of an investment at high prices. Let me show it to you. All right, so we're going to look at this using a real period in history. This is the 2000s. This is actually the same period from the CGM Focus example. You can see it was a difficult decade to invest. Market crashed twice in 10 years. Some people, this is referred to as the lost decade in investing. Some people say the worst decade to invest in history. You can see the S&P 500 finished the decade down 24%. Well, how did dollar cost averaging do with this market? Let's take a look. On the top, we have just the stock market again. On the bottom, what we're looking at in the green is the number of shares that a monthly investment program is able to purchase over this market cycle. Okay, so I'll walk you through it. At the beginning, we can see the market is at a high, it's at a peak. Prices are high. So when we make our monthly purchase, our dollars aren't going very far, right? High prices. So in this example, we're only able to purchase about 3.5 shares. Then the market begins to sell off. So as our monthly purchases roll in, you can see we're able to buy more and more and more shares, lower prices. The market then recovers. Our money starts to not go as far. The market crashes. We're able to buy more shares, so on and so forth, right? Hopefully you get it. Now, if you look at the screen and you just look at the shape of the blue line and the green line, I wonder if you notice something. Just step back. Do you notice that this monthly investment is, in fact, a buy the dip strategy in disguise? Do you see it? Do you see how the green line is peaking right when the market is at its bottom? Look at this. Perfectly timed the financial crisis bottom. Now, of course, you weren't trying to, quote, time the market. It's just built in to this mechanism. The strategy naturally purchases more shares at low prices than high prices. In fact, you purchase nearly twice as many shares at low prices than at high prices, which is what you're trying to do. And just through this smart buying, your return would not have been the market's negative 24% return. You would have been positive 5.9%. Not spectacular, but way better than losing 24%. So that's one reason why dollar cost averaging is a much better strategy than waiting to buy the market dips. It is buying the dips. But there's another reason. For that, I want to hit you with my last and final poll. Okay, and for this, please don't cheat. I know you're on the internet here. Let's use our brains. What I want to know is this. I want you to just think back to last year, 2019. Try to recall how the market did. Was the market up in 2019? Was it down? Did it stay flat? If it was up, how much do you remember it being up? Last year's stock market, up, down, flat. If it was up, how much was it up? What do you say? This is a tougher one. But it's anonymous, so no shame in being wrong. Last year's stock market. Was it up? Was it down? Was it flat? If it was up, how much was it up? Okay. So we had a three-way split, actually. So a third believed that stocks stayed about the same. A third believed that stocks increased, not sure how much. And a third believed they were up 30. Right answer is that the stock market was up 33%, thereabouts. So those that said 30% got that right. Congratulations. The fact that a third of this audience got that right, you actually did much better than the American public. I want to show this to you. So I stole that question from a survey that's given each year to the American public. This is done by Gallup. We're looking at the one that was done in 2014, but they're all, I could have chose, this is just a representative example. You can see the survey took place in the middle of 2014, asking people about what happened the prior year in 2013. Same question, copied it word for word, just updated the dates. Same range of choices. In 2013, the market was up 30. You can see that just 7% of the American population got that right. And this is very representative. We've done this year in and year out. Here's what we've learned. People tend to know when markets crash. They tend to be unaware when markets are making gains, okay? So people, in the good years, America doesn't notice it, okay? That's the takeaway lesson here. Now, why would this be? The big reason here is the way that we receive our news. In fact, Nelson hinted at this in the intro. The news tends to cover bad news. There's that saying in the newspaper industry, if it bleeds, it leads. In order for something to be the lead story in the newspaper, somebody's got to be bleeding. There's got to be a tragedy in the world. There's got to be bad news. This is what causes us to tune in. And so the news disproportionately covers bad news. And the good news often doesn't get reported on. For example, if the market is up, let's say 1.5% today or whatever, it's not going to get covered because it's just not that interesting. Well, what did we see with the dog and the owner chart? The market is often rising. And so I think what happens is we just aren't aware of how well the market does the majority of the time. And the reason that dollar cost averaging is a better strategy than waiting to buy the crashes is that the crashes don't happen that often. Here's a quote. While you wait for the next step, the market is likely to keep rising and leave you behind. Dollar cost averaging gets you involved. Here's an unlikely quote from Napoleon Bonaparte. This was his definition for military genius. I love it for investing genius. He said, the man who can do the average thing when all those around him are going crazy. Dollar cost averaging, as the name implies, is average. It's boring. If you just set it and forget it, no one's going to be impressed with your strategy. But as I showed you, it's a strategy that's been proven to outperform. So set up an automatic investment plan. Just let it ride. All right, number 4. Remember the most powerful force in the universe. Believe it or not, Albert Einstein once said this: the most powerful force in the universe is compound interest. How about that? Think about all the forces that this guy studied in the universe. He's saying the most impressive force that he found is an investing force. Compound interest is an investing thing. So why is Einstein impressed, and what is it? Well, let's look at a very simple, classic investing example. It's called a very expensive cup of coffee. If you buy coffee out at whatever coffee shop you like to go to, the national average for a cup of coffee purchased out is $3. If we, instead of buying a cup of coffee out every day, if we invested that, how much would we have after 40 years? Well, if we assume the historical growth rate from the dog and the owner chart of 6.6%, it grows to more than 210,000. Not enough to retire on, but this is actually a really impressive amount of growth, given that all you're doing is investing $3 a day. So why does it grow like this? Well, it's because of compound interest. What is that? If you look it up online, you're going to find a lot of technical definitions that are hard to understand. I'm going to try to make it easier. It is a little technical, but I'm going to choose a layman's definition from Benjamin Franklin. Yes, that Benjamin Franklin. He's a big fan of compound interest, as I'll tell you a little story about him and compound interest in a moment. He defines it this way: compound interest is money makes money, and money that makes money makes money. All right, I know this doesn't seem very helpful, but you'll get it here in a minute. Let's look at the math on this coffee problem very briefly. It's helpful. So we're saving $3 a day. $3 a day times 365 days in a year is 1,095. That's what goes into the account. It grows by the growth rate of 6.6%, so that at the end of year 1, you have this amount. In year 2, compound interest kicks in. So first, you invest in another 1,095. That's just instead of buying coffee. That's what you're committed to do each year. It gets added to what you already had in the account from the prior year. You can see those numbers match. So this is what's in the account, which now grows again by 6.6%. So at the end of year 2, you have $2,411.58. Years 3 and following look the same. Okay, so let's think about Ben Franklin's definition here. It's when your money, the money that you have in your wallet, makes money. How did it do that? You invested it. And money that makes money makes money. It gets reinvested, right? Including the interest that you made in year 1. You're not taking the interest out of the account, you're reinvesting it so that it grows. The interest compounds. That's where we get the phrase from. This is what it looks like on a chart. The yellow shows you what $3 a day saved looks like because of investing in compound interest. It grows to more than 210,000. What I want you to notice is the upward sloping line. It gets more and more impressive the longer you let it go. This is why people tell you to get started with investing as quickly as you can, because the longer you let it go, the more time works on your side. Let's look at not investing $3 a day, but $6,000. That's the IRA max contribution limit. This is a much more realistic example for those of us that are saving for retirement. A lot of us could do this through some careful life planning. If we did that for 40 years, it would grow to more than 1.1 million, which starts to be much more workable for retirement. Benjamin Franklin loved compound interest just like Einstein. At the end of his life, he did something very interesting. He gave $5,000 to Boston, $5,000 to Philadelphia. He put that money in an investment account and he told the cities, hey, you can't touch it for 200 years. Well, if we look at this curve at 40, imagine what it looks like at 200 when compound interest is really ripping. And that measly $5,000, tens of millions of dollars. Boston and Philadelphia are still trying to spend that money to this day. The reason this works, of course, is that time is on my side. Yes, it is. Very famous investors here, the Rolling Stones. One more from Buffett. The stock market is a device for transferring money. from the impatient to the patient. We have to be patient. Time becomes very powerful because of compound interest. All right, last point, invest in businesses, not stocks. This is actually my favorite point. All right, so what do I mean here? I have this conviction that most people have no clue what they're involved in when they invest, okay? The basic idea of investing is just this. It's about supplying capital to businesses that you believe in, partnering with them, and hopefully growing with them over time. That's what investing is. What's investing like today? Today, people aren't really thinking about choosing businesses that they believe in. It's just about investing in the market, like this abstract financial entity where you just kind of own everything. You don't really care what you own. You're just riding the wave where you put your money in, you hope it's going to spit out a better result in the future. You have no clue what you're investing in. Well, what happens if we have this mentality? If we lose track of the company perspective? Well, the relationship we have to investing is really just a performance relationship. And so it's going to be a rocky relationship. Market's up, we feel great. Market's down, we feel terrible. This is a professor from DePaul who talks about what it feels like to be an investor. Try this on. Retirement accounts tend to just go into mutual funds, whereas an investor, not only do I not have any idea how the companies that I have stock in are being operated, I don't even know what companies I have stock in. And these investments are run by an elite of managers whose one preoccupation is with profit, increasing the bottom line. Have you ever felt this way? Have you ever thought about investing and thought, gee, where does the money come from? What are the companies that I own here? What are the products and services that I'm profiting from? Do I feel good about this whole relationship? Many people will have this back of the mind worry that who they are as a person, maybe their faith, their beliefs, their values, their ethics, their commitments in life, are somehow not being reflected in the kinds of things that they own in their stock accounts. Let me give you the inside view into the industry. This is a very representative view. There are many investment managers who would hold to this kind of philosophy. I heard this person at a conference a few years back. He said, I pride myself on not knowing what's in our portfolios. He's a portfolio manager. I want you to think about this. His job is to pick companies for the portfolios that his clients will then own. Okay, so that's his job. He's saying that he considers it a point of pride to not even know the names of the companies that he's putting in the portfolio. Now, why? That's weird. Well, you may guess, he's a numbers guy. He just wants to see certain financial metrics when he's looking at stocks. In fact, he doesn't even want to see the name because he thinks that's going to cloud his judgment. If the numbers are right, it's the right company and it makes it in the portfolio. And there's a kind of impressiveness to this, right? It's rational, it's disciplined. But when we think about investing being company ownership, to not even know the names of the companies that we're choosing, I think it's a loss. I think we need to remember that, hey, when we invest, we're going to put money in companies. In exchange, we're going to get the rights to profits and growth. The profits and the growth are going to flow from whatever it is that company's doing in the world, good or bad. And so whether it feels like it or not, our values and our ethics are at play. This is the concept of values-based investing. And so really the point here is, yes, we need to save up for the future. We should have profit questions about the companies we invest in. We should also have ownership questions, since that's what it is. So let me get you thinking about this. We could say, for example, what are the leaders of companies that we're looking, what are the ideal leaders we're looking for here? What about how companies treat their customers, their employees, their suppliers, the communities they're based in, the natural environment, society as a whole? To get you thinking, here's some questions. Would we want to work under the leadership team? How likely would we be to recommend their product or service to a friend? Would we want our son or daughter to work at this company? I think it's a great litmus test. On a scale of 1 to 10, 1's a new flavor of gum, 10's a cure for cancer. How much value does this company's products bring to humankind? If we walked into a supply center, would we be proud of the quality and working conditions? What would our reaction be if this company opened an office in our neighborhood, opened a supply center, plant, or factory? And does this company's environmental policy and actions leave a better planet for our grandchildren? If we think about investing as stocks or the market, and that's only a financial thing, these questions, of course, don't occur to us. But when we see investing as company ownership, they start to become very natural. It's like if somebody in your home community came to you looking for you to invest in some business they were starting. Would you say, great, send me over a spreadsheet of the numbers and I'll let you know? Well, we might say that, but we might also say, right, like, hey, well, what's your product? Is it going to be a good one? How's it going to meet needs for people? How are you going to find employees that are excellent? How are you going to treat your customers? How are you going to create value for them, et cetera? We would ask company ownership questions since that's what we're doing. Same thing with public investing. It just doesn't feel like it. All right, last quote. This mindset, when you sort of regain control over what you're investing in by knowing what you invest in, it gives you a kind of peace of mind. So this is a long quote here, but it's the last one. So please read along with me here. And this is, by the way, from our portfolio manager. This is the thing that sounds a little bit like marketing, but there's a good principle here. By investing with Eventide, you will grow in your peace of mind. How do we get it? Peace of mind is the byproduct of trust, and trust is the byproduct of knowledge. Many people have had the experience of purchasing a stock, becoming nervous as it declined, then selling out at a loss, perhaps only to see it go right back up. On the other hand, if a person knows the business the stock represents, trusts management, so comes to believe in the company, these declines are not so troubling. That person is a confident investor because history has shown that great businesses not only endure downturns, but emerge even stronger, making these declines attractive points to invest further. At Eventide, we help investors understand the merits of our portfolio companies so they can better appreciate what they own and thus transcend a mere chart-based financial relationship. Eventide investors can then have greater confidence and less stress because they're not buying mere paper or derivative, but a portfolio of quality businesses they know and trust. After all, life should not be spent staring at computer screens watching ticker gyrations, but instead free from needless stress. At Eventide, we strive to help give you that peace so you can spend your time on what matters most. One last time, keep your eye on the owner, not the dog. Restrain yourself. Employ a system that forces you to buy low. Remember the most powerful force in the universe and invest in businesses, not stocks. With that, I'll welcome back our gracious hosts, and we can try to take some questions here. I will remind you that you can ask a question by going to your controls. There's a little Q&A button there. If you punch that, there's a way to type a question in. We'll see it on our end, and we'll do our best to answer any questions you might have. Don't be shy. Investing's intimidating, but this is about education. So with that, we'll wait for those to come in.
Yeah, thank you, Jason. Really appreciate that information. Thanks for taking the time to go over that with us. For those of you listening in and maybe watching the slides online, I hope that you guys were able to really see some interesting perspectives there on investing. And I know I've listening to the guys at Eventide is always informative for me, especially when, just kind of a little background here. I use some of the products at Eventide in our client portfolios for many of the reasons that Jason covered. And it really helps to know, kind of what I'm putting my clients into. And so I find it very helpful. The perspective that they bring, the knowledge that they bring has really been a benefit. So we'll just kind of maybe wait another minute or two, see if there are any questions that come in.
Yeah, so one question maybe while we sit tight. I'm always curious to talk with advisors. Which of these timeless truths do you feel like is a relatively new concept when you speak with clients? Is there one of those that you feel like, man, they've just never really fully grasped this idea, and you end up talking about it with clients?
Yeah, it's interesting. I don't know if it's maybe a new concept. It's probably something that we have heard time and time again, and it's something that I've talked about and I've done presentations on before. And I like to refer to it like Carl Richards, who is a columnist for the New York Times, as the behavior gap. And he describes this this gap in the investment return and investor returns.
Absolutely.
And and I think you showed a great example of that when the slide that looked at all of the different types of investments and where the investor actually came out, and they're not even beating inflation.
I know, which means
Eh,
they're losing
yeah.
money, real
So
terms.
right, they're losing money. They're losing that opportunity to enhance their plan, and it's because of we shoot ourselves in the foot, unfortunately.
Yeah.
And not to necessarily try to plug what we do at Provident Oak, but wherever you're getting advice, wherever it's coming from, are they, one, do you trust them to give you advice, and two, are they providing you advice that's going to keep you from hurting yourself and your long-term goals?
Yeah.
And that's what's important, is to really put yourself in a position to get advice. And that's what financial advisors do, is really try to keep our clients from hurting themselves when they make these types of decisions.
Yes. Yeah. No, that's great. You really said it well there. The other one, you know, that first chart with the dog and the owner, I actually feel like very few people have seen that chart. In fact, it was quite a bit of work to produce because the older data there's a person at Yale who's done a really good job of collecting that data, Robert Schiller. And when you do those couple of transformations, adjusting for inflation, reinvesting dividends, it's like, I don't think many people have even seen that chart. But when you see it, you're like, you're telling me that for the entire history of investing in the US, it's been, essentially a straight line experience, despite all the crazy things that have happened. That to me just gives so much comfort, because you're like, okay, well, yeah, this virus is crazy, but so was World War I, so was the Great Depression, so was World War II, so was 9/11, so was the meltdown of the global banking system, and the market has proved to be very resilient. And this is, I think stocks, it's the Wild West, right? You can lose your money. I don't want to shortchange that in any way. It's risky. But when we view it on these long time horizons, businesses have grown well in the US, and they've shown a lot of resiliency. And I expect that coronavirus is not going to be the end of the American business economy and stock market. And so that chart to me is just a huge, huge comfort, just to see how consistent of an experience it's been over long time periods.
Right. And our clients that are listening, and they've heard me say this repeatedly, probably they're probably tired of hearing it from me, but I always want to remind them that the news is going to sell panic and despair. And why do they do that? They do it to sell advertising time. And so kind of watching the news less can be helpful, especially when it comes to our investment decisions.
Yeah.
And having a plan. And as we saw before, having a plan, an investment plan, whether it's dollar cost averaging or whatever that plan is, why do you have that plan in the first place? And what is that plan supposed to do for you? And whenever we go through times like we have over the past couple of months, we can always go back to that plan and just review it, make sure that it still applies, and that that the reason that we're doing that makes sense for us. And we want to make sure that that we are sticking to that plan, especially at times when things are uncertain.
Yeah, it's so when I put this presentation together, I collected the thoughts from Fenny, our chief investment officer. These were his recommended points. But when I was getting his thoughts, I was like, what are some of the key lessons you would say are important to communicate on investing? One of the points that didn't make the cut, but was in his, I'd say, top 10, is don't check the news very often. It's a practice that he practices in his family. It's a practice that he practices in his investing. It can, the up to the minute scrolls through Twitter and all these things, it can just cause so much anxiety, and it causes you to have this I need to do something right now. And so, kind of a digest version of reading the news, let's say on a weekly basis, or something, like whatever makes sense. But you can really, really, I would say, exacerbate that emotional trigger that you have within you to sell or to buy if you are just, riding the wave of the news.
Absolutely. I think another kind of perspective that you talked about here was ownership. And what does that actually mean as an investor? And my belief is that if we take that into account and we look at the fact that we are business owners whenever we own a share of stock, I think that would really cause us to pause and think about our investments, not just in a maybe values-based way or a way that we are concerned with if it contradicts our beliefs, but also in a business sense.
Absolutely.
Does this business make sense? Do people want their products? Are their products going to further further our economy or further our lifestyle in a positive way, instead of blanket buying of companies out there without even giving it a thought as to whether or not we even want to own XYZ.
Right. Yeah, no, absolutely. There's, and I view those as like kind of two sides to the same coin. Businesses that I have some friends who've started small businesses, and there's a part of me that's like, I kind of wish I could invest in their businesses because I'm just so impressed with how they're running it. I love, the quality and attention to the products they're giving. I feel like it's being run in an ethical, excellent manner. That's the kind of the concept. Investing is about looking at the world of companies and being like, man, I want to own that company because I really believe in what they're doing. I'm so impressed. I admire their work, and you're behind it. And you want to. I want to partner with this company for the long haul, instead of saying it's kind of trading down today. Let me dump it and buy it back later or whatever.
Right. And why did we buy it in the first place if that's the the attitude we have towards it?
Well, yeah, absolutely.
Okay. Good stuff. Well, I guess we have a shy crowd today, and that's okay. If if you're listening, and you have questions, maybe you want to know how some of these ideas can be implemented into your financial plan. Please don't hesitate to reach out. My direct email is listed there on the screen, as you can see. So you will be able to contact me directly, and I'd be happy to either sit down with you and discuss this, or even have a phone call. Whatever works for you. My concern is that you're getting the advice you need to enhance your long-term goals there. So, Jason, do you have anything else?
No. Hey, thanks. This has been fun, and thanks for everyone participating. And I had a good time. Appreciate it.
And I appreciate you taking the time with us. And if you didn't hear at the beginning, this was recorded. So if you found it useful and you think that someone else out there could use the information and would find it useful as well, I will have a recording of it. We'll be able to send it out and get the maybe a well-kept secret, not so secret anymore.
Great.
All right, Jason. Well, thank you very much. Thank you for listening. Thank you for taking your lunch break with us, and we'll talk to you soon.